Global markets are digesting the Fed's big and somewhat surprising rate cut, and in Australia, the focus turns to tomorrow's cash rate decision from the Reserve Bank of Australia. China's yuan strengthens to its highest level since May last year, and it's not all just about lower US interest rates. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ economist Krystal analyses how lower oil prices will help some Southeast Asian economies more than others, especially with lower inflation and better current account deficits.
This combination is going to open up scope for a deeper rate-cutting cycle than otherwise would have been the case, especially if weaker global growth is a key driver contributing to subdued energy prices.
But first, in 5 and 5 with ANZ, global markets are digesting the Fed's big move last week and the Bank of Japan's decision late on Friday not to hike again, as expected. Now the dust is clearing. ANZ Group Chief Economist Richard Yetzinger says the 50-point move by the Fed to start its easing cycle was still puzzling.
Going off what the Fed had been saying, the way the data had been printing, I don't think there was any other conclusion other than they would go 25. I mean, the only scope for 50 that I was discussing was if you think you need to go 25, 25, 25 before calendar 2024 is out, maybe you could go 50 up front, but clearly signal that. To some extent, they did that, but also to some extent, they signaled, well, if they'd had a bit more data last meeting, they might have cut then. So, look, all in all, I would say the Fed is left with a bit of egg credibility to deal with because they had plenty of chances to be clear and they weren't clear.
Number 2. Richard says the Fed has now flipped to focusing on the jobs market rather than just inflation.
It seems pretty clear that they have made quite a shift to the idea of really trying to balance their employment objectives against their inflation objectives, and they can see employment is now consistent with target. They're going hard to make sure unemployment doesn't increase much more.
Number 3. The main focus for markets in Australasia this week is the RBA's monthly cash rate decision tomorrow. Markets are firmly of the view there will be no change. Here's Richard again.
If there was even a glimmer of hope that the bank would start their easing cycle this week, last week's employment numbers put paid to that. I keep expecting a weak employment number and it keeps not coming, so we've got to take the data as it is, and what the data is saying at the moment is the economy is too strong and inflation too persistent. Let's also not forget monthly CPI on Wednesday. That will show a much larger impact from some of the cost of living policies that we've seen.
Number 4. China's yuan surged on Friday past 7.05 to the dollar, which was the highest level since May 2023. ANZ's head of Asia Research, Koon Go, says it's not just about lower US rates this time.
Despite the ongoing challenges that the Chinese economy is facing, it's really the Fed's 50 basis point rate cut which is putting pressure on the dollar, and that's helping to drive the yuan stronger. But it's not just entirely a dollar weakness story. There's also a domestic element to yuan strength, and that is the Chinese exporters who had previously been hoarding most of their foreign currency receipts. But now with lower US interest rates and a weaker dollar outlook, it looks like they are being enticed to convert more of their export proceeds, selling their dollars, and hence that's also leading towards yuan strength as well.
Number 5. Ahead of tomorrow's on-hold decision from the RBA, some market players beyond Australasia may wonder what makes the Australian Central Bank an exception and the Australian economy. Here's Richard.
Part of it may be Australia's real interest rates are a bit lower, and when I discuss this issue, I use that word a bit quite a lot because the cycle in Australia doesn't look that different. The timing looks a bit different. The level looks a bit different. Real interest rates a bit lower, headline inflation a bit higher, employment growth a bit stronger, job ads are not quite as weak. But when you stand back and look at the broad setup, the vast range of probabilities suggests the next move is an easing. It's just going to take a bit longer in Australia.
Richard Yetzinger there. Now, in our bonus deep dive interview, ANZ Asia economist Krystal analyses how lower oil prices will help some Southeast Asian economies more than others. She says oil prices are already starting to drag on inflation, starting with data for September.
Further out, if we do see oil prices stay at low levels, then we're going to see the impact broaden beyond pump prices to other energy-related components. So this is going to mean disinflation will gather pace. The other angle we also consider is that this region are mostly net oil importers. So a period of low oil prices is going to be positive for their external positions.
Just going through the various countries and how sensitive they are to changes in oil prices, which are the countries that are the most likely to benefit the most?
Based on the pump price adjustments we've seen so far, Philippines has seen the sharpest adjustment in pump prices, followed by Thailand and Korea.
And those countries which are unlikely to see so much of a change because of various subsidies and controls?
So far, India, Malaysia, and Indonesia that have yet to see gasoline prices adjust. These countries tend to have a tighter rein on fuel prices. Among these three, India is the most likely to join regional peers in lowering pump prices. The bar for lower pump prices in Malaysia and Indonesia is higher, considering that key fuel types in those economies are still retailing at roughly 15% above their economical selling prices.
And so that's going to be good for the current accounts of those countries who are net oil importers. How does it affect their growth and inflation and interest rate outlooks as well?
Yes, so starting with the current accounts, what we've seen is the fall in global oil prices from their 2022 highs resulted in narrower oil deficits across most Asian economies through 2023. But the improvement has stalled more recently because average oil prices in the first half of this year stayed above the $80 per barrel mark. Now, if going forward, oil prices start to settle in the $70 per barrel range instead, that's going to renew the impetus for oil deficits in the region to shrink again. So in terms of how we estimate which economies will see the sharpest improvement, it's going to be Singapore and Thailand, given their heavier dependence on imported oil.
And how does the changes in oil prices flow through into the food price channel in these countries?
Yeah, so if we observe historically, there's been a strong correlation between global oil and global food prices. And a key reason is that oil is a key input in agricultural production. So it's difficult to isolate the impact of oil price changes on food prices, but there is a positive correlation. So if we assume all other factors influencing food prices remain constant, then it would be the economies with a higher proportion of food in their inflation basket that are more likely to experience a greater reduction in inflation as a result of lower global oil prices. So within Asia, when we look at the inflation baskets across the region, it is India, Thailand, and the Philippines that have the highest food weights.
And does this mean that some countries in Southeast Asia will be able to ease monetary policy faster than if the oil price hadn't fallen so much?
Yes, so if we do see a period of lower for longer global oil prices, that is going to pave the way for lower inflation and also improve external positions across most Asian economies. This combination is going to open up scope for a deeper rate cutting cycle than otherwise would have been the case, especially if weaker global growth is a key driver contributing to subdued energy prices.
Krystal Tan there. That was 5 and 5 with ANZ for Monday, September the 23rd. Catch you tomorrow with a closer preview of that RBA decision. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.